Debt drives growth until it doesn't. At some point, the loans must shrink, the promises unwind, and the leverage reverse. That's when economies deleverage. And history shows it doesn't happen quietly. This episode explores what happens when the world starts to pay its tab. The unemployment, the austerity, the lost decades, and the few moments when countries manage to land softly instead of crash. Begin the great unwinding.
We're tackling something incredibly difficult. What happens when an economy, maybe even the whole global system, just takes on way too much debt? It's not just numbers on a page, is it? The sources we're looking at describe it as having these profound societal political consequences, almost like a path with no exit without some serious pain.
Yeah, that captures it. Imagine trying to pay off a mountain of credit card debt, but everyone you know is also maxed out.
Right.
And then the bank suddenly hikes your interest rate sky high.
So scale it up. That's what we're talking about.
Pretty much. Yeah. On that massive scale, we call it a large-scale economic deleveraging. Essentially, it's a deep, widespread reduction in debt levels happening simultaneously across everyone. Households, companies, banks, even the government.
And how do we measure that?
We track it by looking at the total debt compared to the size of the economy, the aggregate debt to GDP ratio, and we watch for a significant fall.
How does it actually work? Who's doing the deleveraging, and what does it feel like for the economy?
Well, it involves everyone. Economic actors actively trying to lower their leverage. And it's not gentle. It usually means pretty drastic actions.
Like what?
Like forced asset sales, people having to sell things they don't want to sell, substantial spending cuts, sometimes really brutal ones, people saving every penny just to pay down debt.
What about banks?
For financial institutions, yeah, it might mean selling off big chunks of their assets or just slamming the brakes on lending, stopping growth in its tracks. Sometimes they have to completely change their business model because the old way relied on just piling on more debt.
And households and companies.
But at the same time, you see them dramatically increase their savings. And where does that money come from? Well, by slashing spending. Consumption, investment, it all gets cut. People stop buying cars, put off home improvements. Companies delay building factories, stop hiring.
Wow. So this is way beyond you or me deciding to cut back on lattes or pay off a student loan faster.
Oh.
This sounds like everyone in the country is suddenly deciding to live on, beans and rice and hoard cash under the mattress.
That distinction is critical. Normal debt management, that's fine. This large-scale deleveraging, though, that's a macroeconomic phenomenon. It's a crisis point. It happens when everyone is trying to cut back at the same time.
And it often follows a crisis.
Frequently triggered by a preceding financial crisis.
Yeah.
And this collective action has severe consequences. Think about it. If households, businesses, banks, and governments are all trying to shrink their balance sheets at once.
Who's left to buy the stuff being sold? Who keeps spending?
Precisely. The sources really stress this. No single sector can step in. No one can expand, even temporarily, to cushion the blow when everyone else is contracting. That's what makes it so dangerous. It becomes this huge societal event.
And usually this whole mess starts with a party, a big debt-fueled boom.
That's usually the pattern. These painful periods almost always come after big asset and credit booms. Times when leverage just swells everywhere.
Fueled by what? Cheap money? Risks taking?
Often excessive risk taking,
Yeah.
And unusually favorable conditions, sometimes artificial ones. If you look back before the 2008 crisis, householders' corporate debt hit levels never seen before relative to GDP.
And that debt wasn't sustainable.
A lot of it wasn't. It was based on speculation, on asset prices like houses that just couldn't stay that high, based on economic conditions that turned out to be temporary, financial crises, sudden credit freezes, crashing asset prices, balance sheet problems everywhere. They're often the trigger, the tipping point that forces this painful correction.
So the bubble bursts, party's over, everyone wakes up with a massive hangover and a mountain of bills.
Yeah.
But the cleanup, you said it can be disorderly.
That's where it gets really dangerous.
Yeah.
That shift from boom to bust can trigger a disorderly deleveraging. It's not a gentle glide path. It's marked by rapid, often self-feeding collapse.
Like what? What does that look like?
You see sharp drops in bank stocks, financial share prices. The cost for banks to borrow money or insure against defaults just skyrockets. Asset prices get crushed because everyone's a seller, no one's a buyer.
Can institutions fail?
This disorder can lead to the sudden collapse of major institutions because markets just freeze up. They become unwilling or unable to provide the capital needed or absorb the assets being dumped.
So it spills out of finance.
That's the moment it stops being just a financial problem and becomes a massive shock to the whole society. Huge costs for the real economy, jobs, businesses, communities. And if confidence isn't restored fast, the disorder just deepens. It makes the whole deleveraging process even more costly, more destructive.
This is where it gets really interesting for me. It sounds like it's not just a financial mess anymore. It starts feeding on itself, like a financial sickness infecting the whole economic body.
That's a great analogy. A deeply damaging dynamic is these adverse feedback loops between the financial system and the real economy.
How do they work?
Okay, so asset prices fall, stocks, houses, whatever was bubbling up. That vaporizes household wealth. People feel poor, spend less.
Right.
And the value of collateral banks hold against loans. That erodes too. So loans that look safe suddenly look risky. Non-performing loans start rising.
Which weakens the banks.
Weakens banks, sometimes to the point they need government bailouts, which then strains the government's finances. Now, faced with all this falling assets, rising debt burdens, everyone, individuals, businesses, banks, they all prioritize one thing: fixing their balance sheets.
Cutting back.
Cutting spending, cutting investment, cutting consumption. But that reduction in economic activity then pushes asset prices down even further.
So the more prices fall, the more people cut back, and the more they cut back.
The more prices fall. It's a pernicious downward spiral.
And everyone's connected.
Totally interconnected. Your bank holds your mortgage. Your job depends on your company's health. Your company depends on its bank and its customers. So deleveraging that starts in one place, say the banks. It inevitably spills over. It forces households, companies, and eventually governments to all cut back simultaneously.
And that's the key problem the IMF points out.
Yes, that cascade effect is devastating because when all sectors are contracting at once, there's no one left to step in, no one to lend, spend, absorb the shock, support demand. This systemic paralysis is what makes the crisis so long and deep. It turns deleveraging from just a financial adjustment into this fundamental, often traumatic reordering of everything. Economic relationships, views on risk, all warped during the boom, now have to reset painfully. The speed, the coordination, or usually the painful lack of it, determines how bad the societal impact gets. It's like trying to detox an addict by cutting off oxygen and food at the same time. The whole system just seizes up.
Wow. It's a system-wide struggle, huge real-world consequences when debt dependency gets to this point. We'll start with the recent period, say 2020 to 2025, and how central banks hitting the brakes in a high-debt world created its own risks. Recession talk, falling asset prices, trouble servicing debt. Then we'll look at the deep social scars. Deleveraging leaves those terrifying job losses, the surge in poverty, inequality, the strain on welfare systems.
The human costs.
From there, the political fallout, painful austerity, public unrest, how these crises can actually shake governments and drive massive political shifts.
Yeah.
And finally, because maybe it's not all doom and gloom, we'll look back at history, explore those few rare times where maybe a soft landing was attempted, asking, is escaping gravity really possible without major pain?
Question.
So this is about understanding why getting off that leverage treadmill is so incredibly hard, what that means for society, and maybe what happens when leaders pretend there's an easy way out. Recent context. Roughly 2020 to 2025. We all lived through the COVID shock, and the sources say, in response, global debt just exploded to historic highs.
It did. Governments, companies, they borrowed heavily, understandably, to cushion the blow from lockdowns, uncertainty.
But then came the inflation spike.
Yeah, by 2021, 2022, inflation shot up dramatically in many places, levels we hadn't seen in decades. And that forced central banks into action. They had to tighten monetary policy aggressively, even though they knew the world was already drowning in record debt.
And this wasn't just one or two central banks acting alone, was it?
What we saw post-pandemic was this unusually synchronized global tightening cycle. In 2022, central banks across the board, advanced economies, many emerging markets too, started hiking rates with a degree of synchronicity not seen in over 5 decades. That's a direct quote from one source.
Wow. Why?
They were all facing the same monster. Soaring inflation that looked like it could spiral out of control.
Give us a sense of the scale. How fast, how high did rates go?
Well, think about the big ones. The US Fed, the European Central Bank. They went from basically zero interest rates in 2020-21 to rates we hadn't seen in years by 2023. Investors were expecting global policy rates, on average, to hit around 4% in 2023. That's about 2 percentage points up from the lows in 2021.
which sounds small but isn't.
Even where they started and how fast they moved, it was a shock. The Fed, for instance, went from near zero in early 2022 to over 5% by mid-2023. That's the fastest hiking pace in decades. The ECB went from negative rates to plus 4% pretty quickly, a huge shift away from ultra-low money.
So hitting the brakes harder and faster than we've seen in ages,
Yeah.
and doing it while global debt was already at peak levels.
This sudden, sharp tightening collided with record-high global debt, public and private. Global public debt, just as one measure, had jumped to around 97% of GDP in 2023. That's way up from about 84% before the pandemic, and projections had it hitting 100% by the end of the decade.
That combination sounds dangerous.
It immediately raised red flags for economists and policymakers. The fear was simple. Rapid rate hikes hitting that mountain of debt could tip the world into recession or spark financial crises, especially in vulnerable emerging markets.
So let's break down how raising rates actually works its way through the economy. And how does that change when everyone's already deep in debt?
Think of it like plumbing. Monetary tightening sends pressure through several pipes into the economy, and high debt acts like a full pressure multiplier on every single one.
Pipe number one.
The most obvious one, the interest rate channel. Central bank raises its policy rate that pushes up rates everywhere: bond yields, bank loans, mortgages. Now, a high debt economy, this isn't a gentle nudge. It immediately and significantly increases the burden for anyone with variable rate debt or debt that needs refinancing soon. We saw that with mortgages. U.S. mortgage rates hitting over 7%. Corporate bond yields jumping. This higher cost of debt directly squeezes cash flow. For governments rolling over old bonds, for businesses needing loans, for households with adjustable mortgages or credit card debt, big squeeze.
And central banks weren't just raising rates, were they? They were also pulling back support, shrinking balance sheets.
That's the second pipe, the balance sheet, or quantitative tightening, QT channel. Many central banks, like the Fed, started shrinking their balance sheets. They stopped reinvesting proceeds from maturing bonds, or even start selling assets.
What does that do?
It basically removes liquidity, removes money from the system. If the central bank isn't buying bonds, someone else has to, which pushes up longer-term interest rates. The Fed started QT in mid-2022, letting its balance sheet shrink from around $9 trillion.
So that's like another rate hike?
Effectively, yes. It's another form of tightening. It dampens credit, pressures asset prices, and in a high-debt world, it makes it more expensive for governments to issue long-term debt, harder for firms to raise capital.
We also saw huge currency swings during this time. The dollar got really strong.
That's the exchange rate and capital flows channel. When a major central bank like the Fed hikes aggressively, it makes its currency, the dollar in this case, really attractive to global investors seeking higher returns. So in 2022, the dollar surged.
Good for the U.S. fighting inflation.
Helps control import inflation, yes, but it causes pain elsewhere. It makes dollar-denominated debt much heavier for foreign countries or companies. And it can trigger big capital outflows from emerging markets as money chases those higher U.S. rates. The sources specifically say the Fed's tightening contributed to a rapid change in global capital flows towards the U.S.
And other countries felt that.
Oh yeah. Many emerging market central banks felt forced to hike their own rates preemptively, even if their economies were weak, just to defend their currencies and stop the money flooding out.
Pipe number four. The psychological side. Expectations, confidence.
The expectations and confidence channel. Central banks try to guide expectations about inflation and future policy through communication, but in a high debt world, it gets tricky. If investors start worrying that rising rates will make government debt unsustainable, that erodes confidence fast. It undermines the central bank's power and can cause capital flight or sudden spikes in borrowing costs, another potential vicious cycle.
So those are the standard channels, but you said high debt makes them more potent. How? What's this O-force multiplier effect?
It all comes down to sensitivity. If you're heavily indebted, whether you're a household, a company, a government, you're just much more sensitive to borrowing cost increases. A 1% rate hike eats up a much bigger chunk of your income or revenue compared to someone with low debt.
So the same rate hike causes a bigger reaction.
A much bigger cut in spending. Empirical studies confirm this. Output falls more sharply after rate hikes in countries with high private debt. Why? Higher debt service costs squeeze disposable income for households. Leveraged firms have less cash for investment and are scared to borrow more.
Does the effect last?
Yes. One analysis found consumption and investment stay persistently lower after a rate hike in high debt environments. Plus, high debt increases the risk of actual financial distress, defaults, bankruptcies. So tightening is more likely to trigger those, which then ripple upwards.
It sounds like it hits the most vulnerable parts of the economy first.
It tends to. And there's a distributional effect too. Rising rates transfer income from borrowers, who often spend a lot of any extra cash, to savers and creditors, who tend to spend less. If debt is concentrated among vulnerable borrowers, this shift dampens overall demand even more. So yes, high debt acts as a force multiplier for monetary tightening. Policy becomes more effective at cooling demand, maybe too effective. It significantly increases the risk of a sharp slowdown or even recession.
Let's pause here for a quick recap. So COVID shock, soaring global debt. Central banks react with rapid synchronized rate hikes and QT, a synchronization not seen in over 5 decades. We looked at the transmission channels rates, balance sheets, FX, expectations, but the key is record high debt amplified these effects, acting as a force multiplier. This created a really challenging, sensitive environment for economic stability.
The system became much more reactive, much more fragile.
So what were the big macroeconomic risks that emerged from this situation?
Well, the number one risk was that this amplified tightening would just choke off economic growth and potentially tip the world into recession. By late 2022, the World Bank was explicitly warning about this. They said the world was edging toward a global recession in 2023 if the synchronized tightening kept going.
Why were they so worried?
They argued these simultaneous hikes were feeding off each other, tightening global financial conditions way more than individual hikes would suggest, leading to a steep growth slowdown.
And did we see that slowdown?
Oh yeah. 2023 saw a dramatic cooling. Global GDP growth was projected around 2.0%. That's down from 6% in 2021. Many advanced economies basically stalled. While some big players, like the US up to 2024, technically dodged a formal recession, a lot of indicators were flashing bright red.
Like what?
We saw inverted yield curves, that classic warning sign from the bond market. Consumer confidence plummeted to pre-recession lows. And some key economies actually saw output shrink. The euro area, for instance, had a mild technical recession late 2022, early 2023.
And complicating things, governments, also carrying heavy debt loads, couldn't just ride to the rescue with stimulus like they might have in the past.
The contractionary punch from rising rates was amplified because fiscal space was limited. Normally in a downturn, governments loosen the purse strings. But in 2022-23, many high-debt countries were actually tightening fiscal policy. They were pulling back pandemic support, cutting spending to deal with deficits, and rising interest payments.
So monetary and fiscal tightening at the same time.
And that combination, though aimed at inflation and debt sustainability, risked being over procyclical, meaning it could actually reinforce the slowdown and make it deeper.
Has this kind of situation happened before?
It has echoes. The World Bank study specifically mentioned the early 1980s. Back then, the Fed hiked aggressively to kill inflation, which contributed to a global recession and triggered over 40 sovereign debt crises in developing countries. That history was definitely on policymakers' minds from 2022 onwards. Tame inflation, yes, but tightening into high debt and slow growth risked a similar debt-driven hard landing.
Does having really high public debt sometimes tie a central bank's hands, put them in a difficult spot?
In extreme cases, it can lead to what's called afiscal dominance. That's where the central bank feels pressured to keep rates low, not for economic reasons, but because hiking would make the government's debt interest payments unmanageable.
Like Japan.
Japan's the classic example.
Oh.
Public debt over 1,550% of GDP. Decades of low inflation. The Bank of Japan kept rates near zero and used yield curve control right into 2023, long after others were hiking. Why? Hiking too fast could blow up Japan's debt sustainability, so they prioritized stability, even if it meant a weaker yen and higher import costs.
And we saw similar worries in Europe, especially for countries like Italy.
That's right. In the Eurozone, high debt members like Italy with debt around 150% of GDP were very concerned that rapid ECB hikes could cause their bond yields to spike relative to Germany's. That threatened fragmentation, a potential repeat of the sovereign debt crisis.
How did the ECB handle that?
Carefully. They even created a new tool in mid-2022, the Hold Transmission Protection Instrument, TPI. It basically allows them to buy bonds of countries facing unwarranted yield spikes. This gave them the breathing room to hike rates against inflation without triggering a sovereign debt crisis in, say, Italy. It really highlights that tough trade-off. Fight inflation versus risking a debt crisis or deep recession in a high-debt world.
Did this tightening feel different depending on where you were?
Where the impact varied quite a bit. It depended on the country's financial plumbing. Places with lots of household debt and adjustable rate mortgages, think Canada, Australia, the Nordics, felt it fast, mortgage payments jumped, people cut spending quickly.
But not everywhere.
Not like that.
Yeah.
In the US, most mortgages are long-term fixed rate. So existing homeowners were more insulated initially. The hit there came more through things like new housing construction collapsing or businesses finding it harder to invest. Though even in the US, by 2023, higher rates were clearly slowing things down. Banks were tightening lending standards, a sign of slower growth to come.
In Europe.
In Europe, bank lending is really key. Rising rates meant costlier loans for businesses and households. By late 2023, bank lending had basically stalled, and the whole Eurozone economy flatlined.
Yeah.
You could really see the headwinds from tightening in that debt-heavy environment.
Okay, let's sum up this section on the tightening track. Globally, central banks slammed on the monetary brakes hard right into a high-debt world. We saw synchronization not seen in over 5 decades. This tightening got amplified by record debt, acting like a force multiplier, making economies super sensitive. The risks: global slowdown, recession warnings, a World Bank, and this really tricky balancing act for policymakers between inflation and stability, especially in places like Japan, where 250% debt, and Italy, 150% debt, high ECB TPI. And the impact hit differently depending on debt structures faster in places like hot Canada with variable rates, slower but still felt in the US.
And here are those flashcard facts again. Global debt surge. Public debt around 97% GDP in 2023. Synchronized tight. Fastest global pace in decades. High debt amplification. Acts as a force multiplier. Recession risk. World Bank warned of 4 edging toward a global recession in 2023. War recession indicators. Things like uninverted yield curves, low confidence, euro contraction, poor fiscal constraint, governments also tightening, risking sword pro-cyclical pain, or fiscal dominance risk, high debt potentially constraining central banks, show Japan, Italy, or varied impact. Transmission speed depends on debt type, variable versus fixed. 4, varied impact. Hashtag asset prices under pressure and debt servicing challenges.
So rising rates mean higher debt costs, slower growth. What did this do to asset prices? Things like stocks and housing that boomed during the cheap money era.
Well, another major fallout from this aggressive tightening was the deflation of those asset prices. Housing and stock markets particularly had been really boosted by years of near zero rates. When rates shot up, the air started coming out of those bubbles.
Let's start with housing. How bad was it?
Housing markets are super sensitive to borrowing costs. The sharp rise in rates after 2021 quickly cooled down what had been red-hot real estate markets almost everywhere. An IMF report in early 2023 found widespread declines in inflation-adjusted housing prices in about 2/3 of the countries they looked at. A really dramatic U-turn from the pandemic boom.
Let's take the US as an example. What happened there?
In the US, the Fed's hikes pushed the average 30-year mortgage rate above 7%, levels not seen in 20 years. That created an immediate affordability crunch. Every 1 percentage point increase adds roughly $100 to the monthly payment on an average loan.
Wow.
Yeah, it priced a lot of buyers out instantly. Home sales volumes plunged. Now, nationally, U.S. home prices only saw modest year-over-year declines in 2023, the first drop since 2012. But that was partly because inventory was low, and many existing owners were locked into old low rates. Still, some previously booming markets saw much bigger corrections, double-digit drops.
But other countries saw even steeper falls.
Many other advanced economies had bigger corrections, especially places with huge price run-ups, high household debt, and more adjustable or short-term mortgages. Think Canada, New Zealand, Australia, the UK, the Nordics. They saw home prices fall 10-15% or more from their peaks.
New Zealand was particularly bad.
New Zealand's a standout case. Their central bank hiked rates from 0.25% to about 5.25%. House prices then fell roughly 17% in about a year, late 2021 to late 2022, one of the steepest drops anywhere. Sweden, with lots of variable mortgages, saw prices fall around 15%.
And the mechanism is simple.
Brutally simple. Higher rates mean higher mortgage payments. That crushes affordability and demand. Plus, it raises costs for landlords, maybe forcing sales. The rule of thumb, a 1 percentage point rise in real mortgage rates usually slows annual house price growth by about 2 percentage points. After years of easy money inflating prices, tightening threw it all into reverse.
What are the risks when housing turns down like that, especially in a high-debt country?
Big risks, especially where household debt is high and mortgages reset quickly. Falling prices eat into household wealth, erode homeowner equity. That increases default risk if people lose jobs. It also raises worries for banks about the quality of their mortgage books.
Were there factors holding back a wave of defaults?
In 2022-23, strong job markets helped. Plus, many people did have fixed rates or pandemic savings buffers. That provided some cushion for a while. But the softening was global. The IMF specifically warned countries with both high house prices and high household debt, especially floating rates, are the most vulnerable. They cautioned late in 2023 that if unemployment were to rise significantly, serious financial strains could emerge. Falling home values, harder debt servicing, a dangerous mix.
What about stock markets? They felt the pain too.
Dramatically. Higher interest rates do two things to stocks. One, they reduce the present value of future company earnings, makes future profits worth less today. Two, rising risk-free bond yields make stocks look less attractive by comparison, so valuations get squeezed.
And 2022 was rough.
2022 was a proper bear market. The MSCI World Index fell about 17.7%. Emerging market stocks made 19.7%. The U.S. S&P 500 dropped around finished at 19%, its worst year since 2008. Tech and growth stocks, which are really sensitive to interest rates, got hammered even worse. The Nasdaq fell over and hit 30%. European, Japanese markets also saw double-digit drops.
And this was directly linked to the rate hikes.
Directly. One review put it bluntly, 2022's inflation and rapid hikes destroyed the bond market and sent stocks into bear market territory. What was unusual and painful was that both stocks and bonds fell sharply together. That undermined the usual portfolio hedging strategies. Central banks were in a tough spot. Falling asset prices were part of the plan to cool things down, but if they fell too far too fast, it could trigger wider financial stress.
Were other assets hit?
Yep. Commodity prices cooled off after an initial spike. Commercial real estate started looking shaky, higher financing costs, plus shifts like remote work. And we saw spectacular crashes in speculative assets like crypto. Bitcoin fell about 65% in 2022. The easy money party was definitely over.
So the pattern is clear. Aggressive tightening after years of low rates equals asset deflation.
Pretty much. And in a high debt world, that's risky because falling asset values mean less collateral, which can expose hidden financial weaknesses.
Like what happened in the UK with pensions.
The UK pension LDI crisis in autumn 2022. A perfect, if technical, example. LDI stands for Liability-Driven Investment Strategies Pensions Use. When UK government bond yields, gilts, suddenly spiked, partly due to a shock budget announcement, partly global tightening. These leveraged LDI strategies faced huge margin calls. They needed cash fast. It almost caused a meltdown.
And the Bank of England had to step in?
Ironically, yes. The Bank of England was tightening policy, fighting inflation. But they had a U-turn and start buying bonds to stabilize the market. It just highlights how fragile things can be when leverage is high and liquidity gets yanked away quickly. Forces central banks into these really difficult trade-offs between inflation and stability.
So far, we've covered how tightening hits asset prices. Housing cools, widespread declines. Stocks enter a bear market, up 2022. Other assets like crypto crash. In a high debt world, this deflation hits collateral values and can expose fragility, like the UK pension LDI crisis. Now let's talk about the direct impact of rising rates on the cost of servicing all that debt.
Transitioning to debt servicing challenges and financial stability risks, this is unavoidable. When central banks tighten into high debt economies, the cost of carrying that debt goes up for everyone. Governments, businesses, households. The IMF put it plainly. Persistently higher rates raise the cost of servicing debt, adding to fiscal pressures and posing risks to financial stability.
How does this show up for governments?
For advanced economies, which got used to near zero borrowing costs, the impact builds gradually as old debt matures and needs refinancing at higher rates. But it's unmistakable. The UK government's interest bill, for example, hit multi-decade highs in 2023, forcing really tough budget choices.
What about the US?
The U.S. Congressional Budget Office keeps warning. Rising national debt plus higher rates could sharply boost federal interest costs. That could crowd out spending on everything else.
And in the Eurozone?
High debt countries like Italy and Spain saw their borrowing costs jump significantly. Italy's 10-year yields went from maybe 1% to around 4%. Now, the ECB's backstop, the TPI we mentioned, helped prevent an immediate crisis. But these countries are still vulnerable. Rating agencies put some on notice in 2023, France, Italy, saying rising debt and higher rates threaten their creditworthiness. And high public debt means less firepower to fight the next downturn right when central banks are trying to cause a slowdown.
What about businesses and households? How did they feel the squeeze?
For the private sector, the challenges became really widespread. Let's take households. The pain hit fastest in countries with lots of variable rate debt mortgages, consumer loans. In the UK, millions of homeowners faced refinancing their cheap 1-2% pandemic mortgages at rates of 5-6% or more in 2023. Monthly payments jumped by hundreds of pounds.
Did this affect everyone equally?
No. ECB simulations showed lower income households face a disproportionately higher risk of default as rates and inflation bite harder into tight budgets. Now, mitigating factors helped initially. Many people in the US and parts of Europe had fixed-rate mortgages, some had pandemic savings, job markets were strong. That cushioned the blow for a time.
But the underlying capacity weakened.
Definitely. Debt servicing capacity got weaker for many. That leads to less consumption, more credit risk for banks, and housing affordability got stretched even further, not just by prices, but by the sheer cost of financing. The big worry remains, what happens if unemployment rises significantly? High debt plus high rates. That's a recipe for widespread consumer defaults.
What about corporates?
Businesses.
Companies, especially smaller ones or those with weaker credit ratings, saw borrowing costs climb a lot. Yields on U.S. high-yield corporate bonds, junk bonds, roughly doubled in 2022, peaking around 8-9%.
Raising fears of defaults. Yes, serious concerns about refinancing risk for firms that had borrowed cheaply. Corporate default rates started ticking up from historic lows. The party was over. The BIS found that corporate credit spreads widen much more steeply after rate hikes when corporate debt is already high. Markets get scared faster.
Did bankruptcies rise?
By late 2023, yes, corporate bankruptcies were rising in some areas, like Europe, back to or above pre-pandemic levels. Firms were struggling with higher input costs and higher debt servicing costs. Small and medium businesses with floating rate bank loans often got hit hardest. And for companies in emerging markets that borrowed in dollars, the strong dollar plus rising U.S. rates was a nasty double whammy, forcing some into restructuring.
In the financial sector itself, banks, they weren't immune.
Far from it. Rapid tightening exposes hidden weaknesses. The U.S. regional banking turmoil in March 2023 was a prime example. Silicon Valley Bank, others collapsed.
Why did they fail?
Fundamentally, interest rate risk. They'd bought lots of long-term government bonds when rates were super low. When the Fed hiked rapidly, the market value of those bonds plunged, creating huge unrealized losses on their books. Combine that with other factors like concentrated deposits and bank runs, it showed up quickly risks can blow up in this environment.
And it's not just their bond portfolios.
No, banks are also exposed through their loans. As rates rise, more borrowers struggle to pay. That means more non-performing loans, which eats into bank capital. And then there's the bank-sovereign nexus, especially in Europe and emerging markets. Banks hold lots of their own government's debt.
So if the government gets into trouble,
the banks get into trouble, and vice versa. The IMF warned this link gets worse at high debt levels. The government has less capacity to bail out banks, and banks holding government debt get hit if the sovereign faces stress. A big concern in Italy, and particularly in low-income countries. The median bank there holds about 13% of its assets in government debt, double what it was a decade ago. The bottom line, higher rates plus high debt, a more vulnerable financial sector. Capital eroded by bond losses, loan defaults, and sovereign stress feeding banking stress.
Finally, how did all this hit emerging markets specifically? They often seem most vulnerable.
They face some of the toughest challenges. Many low-income countries were already struggling with debt after COVID. Rising global rates just poured fuel on the fire. By 2023, 9 low-income countries were officially in debt distress, couldn't pay their bills, and another 25 were at high risk.
Why was it so bad for them?
Higher global rates plus the strong dollar dramatically increased the cost of their external debt, the money they borrowed internationally, even if their own economies were weak. Countries like Sri Lanka, Zambia, Ghana defaulted or restructured between 2020 and 2022. Global tightening was cited as accelerating their loss of market access. One research group noted global tightening from 2021-23 exacerbated external debt payments and placed increasing pressure on global financial stability. Developing economies had to pay more to borrow just when they could least afford it.
What about their domestic policy?
Many EM central banks, especially in Latin America like Brazil, hiked their own rates very aggressively, very early. Brazil went from 2% to 13.75% between 2021-22. They were trying to fight inflation and support their currencies. It helped on that front, but it choked off domestic credit and growth and jacked up their domestic debt costs too. Dozens of developing countries ended up spending more on debt interest payments than on vital services like health or education. That really underscores the immense social strain.
Were there any signs of resilience? Were things better than in past crises?
Yes, some silver linings. Overall, EMs were maybe a bit more resilient than during past U.S. hiking cycles, like the 2013 taper tantrum. Many had improved their fundamentals, built up more foreign exchange reserves, issued more debt in their own local currency rather than dollars, and big EMs like Brazil, Mexico, India hiked rates preemptively ahead of the Fed, which helped anchor expectations and prevent complete panic.
But still vulnerable.
Definitely. Spillovers were clear. Capital flows to EMs dried up in 2022. Countries with weaker fundamentals or lots of dollar debt still faced acute stress. The IMF was cautious, saying key EMs with heavy debt loads are much more vulnerable to capital outflows, currency depreciation, and rising inflation expectations when global rates rise. Many EM currencies fell sharply in 2022. You could feel the anxiety whenever there was talk of the Fed pivoting.
Let's recap the debt servicing and financial stability challenges. In a high debt world, tightening hikes costs for everyone: governments, show UK, Italy, businesses, star rising defaults, households is especially variable rate. This strains budgets, raises default risks. Financial sector fragility gets exposed to interest rate risk, SVB crisis, the bank's sovereign nexus. Emerging markets face acute pain, a 9 distressed LICS in 2023, many spending more on debt interest than health education, though some showed resilience. It all highlights the major financial stability risks when you tighten into high debt.
And the flashcard facts for this part. O, rising debt costs, strained public-private budgets globally. O, corporate defaults, ticking up as rates rise. O, bank fragility, exposed by interest rate risk. O, SVB crisis, go bank sovereign nexus, dangerous link between government bank stability, only EM debt distress. 9 low-income countries in distress 2023, 25 at high risk. O, social strain, debt interest, health education spending in dozens of countries. O, EM vulnerability, high debt EMs all much more vulnerable to outflows, depreciation, or asset deflation. Tightening hits housing, widespread declines, stocks, a 2022 bear market, crypto, etc. Financial system fragility, exposed by asset falls, e.g. UK pension LDI crisis, or financial system fragility, hashtag tag the social scars and political reverberations of deleveraging.
We've covered the economics, the financial markets, the mechanics, but what does this mean for people, for society? How does this economic storm translate into real human hardship and political upheaval?
This is where we really see the profound human cost, drawing from that first source. The economic pain, the financial instability we've discussed, it inevitably inflicts deep social wounds and fuels significant political challenges. Let's start with maybe the most direct impact jobs.
Unemployment, the specter of unemployment.
A big jump in unemployment, often lasting a long time, is one of the most immediate and devastating consequences of large-scale deleveraging. How does it happen? Well, a few ways. First, the credit crunch.
Banks stop lending.
Financial institutions are deleveraging, so they cut lending. That starves businesses, especially smaller ones, of the cash they need. So they cut costs, and labor is often the first thing to go. Layoffs, hiring freezes, or businesses just shut down. Second, remember everyone's cutting spending. Households, firms, trying to fix their balance sheets. That causes a massive drop in aggregate demand. People stop buying things, companies stop investing. So other firms have to cut production, fire people, cancel projects. It feeds on itself.
The paradox of thrift.
Precisely. Saving is good individually, but if everyone saves by slashing spending simultaneously, the whole economy tanks, leading to job losses that ironically make it harder for everyone to save. And third, you get old fire sales. Distressed firms desperate for cash sell assets cheap. That pushes prices down further, worsens balance sheets, kills confidence, prompts more layoffs.
History gives us some terrifying numbers on how high unemployment can get during these episodes.
Just devastating numbers. They show the scale of the human cost. Think Great Depression, US, 1929-33. Unemployment soared past 20%, maybe hit 24.9% in 1933. That's almost 13 million people. Factories shut, farms foreclosed. Global financial crisis, 2008. U.S. unemployment doubled from 5% to 10% by late 2009. High-income countries lost over 14 million jobs. Globally, jobless numbers jumped by 27 million. Youth got hit hard. Eurozone crisis, post-2009. Just brutal unemployment in some countries. Greece and Spain hit 27%. Youth unemployment in Greece peaked at an unbelievable 62% in June 2013. Imagine graduating into that. Latin American debt crisis, 1980s. High unemployment, real wages plunging 20-40% in cities. Argentina's 2001-02 crisis saw unemployment peak at 23.6%. Asian financial crisis, 1997. South Korea's rate jumped from 2.7% to 6.1% in just 3 months. And Japan's lost decade, 1990s, 2000s. Unemployment hit an 5.5%, a record high for them. Young graduates face the unemployment ice age. Joblessness for 20, 24-year-olds nearly doubled.
And it's not just losing a job, it's how long it takes to find another and what kind of job you find.
The unemployment often lasts a long time. It can take 4 to 5 years for employment levels just to get back to where they started before the crisis, even after recovery begins. Long-term unemployment becomes a huge scar, like in the US after 2008, and the quality of work suffers. Even if you keep your job, you might face reduced hours, lower pay, fewer benefits. In developing countries, people get pushed from formal jobs to precarious informal work. Official stats might not even capture the full picture, and the burden falls hardest on youth, low-skilled workers, migrants. Japan's lost generation is a powerful example of how this diminishes lifetime opportunities, making inequality worse between generations.
Let's just pause on that. The numbers are brutal. Great Depression of 24.9% unemployment, Grace Youth 62%. Deleveraging unleashes these waves of joblessness, often long-lasting, hitting the vulnerable hardest, degrading work quality. It embodies that painful paradox of thrift on a national scale. It's a fundamental assault on people's lives.
And beyond unemployment, deleveraging drives deeper social divides. It increases poverty, makes inequality worse, and puts enormous strain on the very safety nets people need most. Vulnerable groups get hit hardest, they have the least buffer.
What does that look like for families struggling on the ground?
It means desperate choices with lasting damage. Selling off things they need to make a living, like land or tools. Using up all their savings. Cutting back on food, skipping healthcare, pulling kids out of school. These coping strategies, born of necessity, trap families in poverty for generations. They erode human capital health, education, future potential.
And the poverty numbers themselves, they jump dramatically.
Shockingly so. The rule of thumb from historical data, for every 1% drop in GDP growth, maybe 20 million more people globally fall into poverty. Examples. Indonesia, during the Asian crisis, poverty jumped from 11% to 18%. Urban poverty in Korea doubled. Argentina's 2001-02 crisis. Poverty went from 26% to a staggering 57.5%.
And the systems meant to help welfare, healthcare, schools, they often get cut right when needed most.
Precisely. Social safety nets get overwhelmed, or worse, actively cut back. Governments are dealing with collapsing tax revenues and soaring demand for help. Plus, they might be bailing out banks. So what happens? Like in austerity. Cuts to public spending often hit social services, health, education, welfare.
Painful examples.
Lots. Health spending fell in Indonesia, Malaysia, Thailand after the Asian crisis. Mexico cut education spending so 15% in its 1994 crisis. Peru's education investment fell so 50% in the late 80s. More recently, UK austerity post-2008 meant cuts to welfare, local councils, public services. It can feel like the state is retreating, changing the social contract, leaving people more exposed long-term.
And the gap between rich and poor, it widens.
Almost always worsens. Crises hit the bottom end hardest. They have fewer assets, lose jobs more easily. An OECD study confirmed higher inequality drags on future growth, especially that gap between the poor and everyone else. And policy choices matter. Regressive austerity, bailouts for the rich, they can make it worse. Look at Japan's O-freeders, stuck in insecure, low-paid jobs, earning far less than regular workers, affecting income, marriage prospects. In the UK post-2008, austerity saw real wages stagnate or fall.
The cumulative effect sounds devastating for society.
It is. It often shows up in worse public health outcomes, rising infant mortality, malnutrition, sometimes lower life expectancy, social cohesion phrase. Tragically, some crises see sharp increases in suicide rates, a stark measure of societal distress and lost hope. These aren't temporary blips. They diminish human capital, undermine future growth, and risk locking countries into cycles of hardship.
It's clear the economic shock isn't shared equally. It drives poverty, widens inequality, strains safety nets, often leading to cuts in essential services. The human cost is immense: desperate coping strategies, potential declines in health, rises in social distress like suicide.
And beyond those direct impacts, the turmoil can literally tear the social fabric. It leads to physical displacement, forces migration, fundamentally shifts social norms. One obvious sign is homelessness.
Like the Hoovervilles during the Great Depression.
Losing homes and farms led to those shanty towns, massive internal migration like the Okies. More recently, the 2008 GFC caused huge numbers of foreclosures in the US and elsewhere, displacing families, shattering communities.
And it can change fundamental things like the nature of work.
Deleveraging crises can shatter long-held norms. Japan's lost decade is the prime example. The traditional lifetime employment system, pillar of security, started crumbling. That led to the employment ice age for graduates, the rise of freeders stuck in insecure, low-paid temp jobs, huge consequences. Income, security, marriage prospects, sense of status, and policy choices like propping up zombie firms arguably made it worse by slowing dynamism and encouraging temporary work. Short-term fixes creating long-term social problems, altering the whole contract around work.
And the psychological toll of that insecurity must be immense.
Profound. Japan's lost decade was described as creating a stifling feeling of being locked inside a box with no exit in sight, casting a dark shadow on the national psyche. And tragically, as mentioned, some crises see documented rises in suicide rates, stark evidence of severe distress.
This erosion of security and hope, can it lead to more crime, social breakdown?
It can. When traditional paths are blocked, desperation sets in. The Latin American debt crisis in the 80s saw links between hardship and rising crime, some turning to illicit activities. Japan's employment ice age has also been linked to crime by alienated youth. Losing faith in the system, losing hope, can create fertile ground for radicalism or just apathy and decay. So to recap the social scars, beyond the stark economics, deleveraging displaces people, Hooverville, GFC foreclosures, shatters norms like Japan's lifetime employment, creating insecure freeders. Deep psychological distress follows, sometimes linked to rising suicide rates. The fraying social fabric can even see increases in crime. It leaves lasting marks on generations, on the national psyche. And the flashcard facts on social impacts: unemployment spikes, extremes like USO 24.9%, Greece youth 62%, a paradox of thrift. Collective saving hurts overall economy.
Poverty surge.
A 1% GDP drop minus 20M into poverty. Sun, austerity cuts often hit health, education, welfare when needed most. Inequality worsens, rich core gap widens, AG Japan's ARFIs. Displacement, Hoovervilles, GFC foreclosures, Sun shifting norms, e.g. Japan's crumbling lifetime employment, social distress, including rises in suicide rates, crime increase, linked to hardship in some crises.
This is where economic and social pain directly fuel systemic unrest and challenge political stability. One very common policy response from governments facing these crises is, austerity, belt-tightening, cutting public spending. It's often seen as necessary when other options aren't viable. One analysis found that 16 out of 32 deleveraging episodes involved austerity. And what does austerity actually mean in practice?
Usually tax hikes, but more often, significant cuts to public spending, social services, public sector wages, jobs, big investment projects, they all get hit. Think Greece during the Eurozone crisis. Deep cuts, tax hikes mandated for bailouts. The UK after 2010. Cuts to welfare, local government, public services, plus a VAT increase. Now, these are often presented as technical necessities, but they can backfire economically, depressing demand, maybe making the recession worse. IMF research post-2008 suggested that in Europe, $1 cut from government spending could shrink the economy by about $1.30. Austerity can be pro-cyclical.
And how do people react to facing economic hardship and government cuts at the same time?
Not well. The imposition of austerity very frequently triggers significant public anger and widespread social unrest. People react strongly to the hardship and the perceived unfairness of it all. History is full of examples. Eurozone crisis. In Greece, from May 2010, massive demonstrations, strikes, often violent clashes. People were furious about unemployment, inflation, corruption, and the cuts. The indignant citizens movement demanded an end to austerity, refusal of odious debt, resignation, justice, jobs. Eurozone crisis. In Spain, the 15M Indignados movement in May 2011, similar anger, mobilized online, protesting crazy high youth unemployment, 43.5%, cuts, corruption, the whole political system. Their mass occupations of squares like Puerta del Sol in Madrid became iconic. Argentina's 2001-02 Corralito crisis. Bank withdrawal limits of Corralito paralyzed everything. Led to furious pot-banging protests, cacerolazos, riots, intense political chaos. Famously resulted in 5 presidents in just 2 weeks. A total breakdown. U.S. Great Depression 1930s, mass unemployment fueled unrest. Unemployed councils organized protests, hunger marches, fought evictions, demanded relief. UK. The IMF crisis in 1976 and the underwinter of discontent 1978-79. Spending cuts and wage limits triggered huge strikes. It shows austerity isn't just economics, it's deeply political. Who bear the cost? Is it fair? Those perceptions drive the scale of unrest, and how much pain society can take depends on trust and cohesion, which are often already low.
So economic pain, social pain, protest. Does this actually threaten the stability of the political system itself?
The pain and unrest often go beyond protesting policies. They erode trust, not just in leaders, but in institutions. It can trigger acute political instability. Crises usually see approval ratings for incumbents plummet, but deep deleveraging can cause a fundamental loss of legitimacy for the whole government. Think Argentina 2001-02. Deep cynicism towards the entire political class lingered for years. This erosion of trust creates volatility where normal politics breaks down. Periods of high public debt and deleveraging are strongly linked with a heightened political instability. Frequent government changes, collapsing coalitions, sometimes even regime shifts.
Can you give some examples of that instability?
Sure, the Eurozone crisis led to unscheduled government changes or major power shifts in or 10 of the 19 Eurozone countries. Greece, Ireland, Italy, Portugal, Spain. Major upheaval. In Greece, the traditional two-party system that dominated for 40 years just collapsed. Argentina 2001-02, that astonishing succession of 5 presidents in 2 weeks, total breakdown. Even Japan's lost decade saw increased political turmoil, scandals, weak governments. The ruling LDP lost its outright majority in 1993 for the first time in 38 years, leading to less stable coalitions.
And these moments can be turning points, right? Where the whole political landscape shifts.
They are powerful catalysts. Economic grievances fuel broader movements challenging the whole existing order, not just the current leaders or policies. The U.S. Great Depression fundamentally reshaped U.S. politics, led to FDR's landslide, the So New Deal, a massive expansion of government's role, a lasting shift, the Latin American debt crisis, 1980s, a juncture. Under pressure from IFIs, most countries abandoned old models, adopted 2 neoliberal market-oriented strategies, a huge, often externally imposed paradigm shift. The Arab Spring, from late 2010, had deep economic roots. High youth unemployment, Tunisia 30%, Egypt 25%, rising food prices, corruption, inequality all fueled anger against authoritarian regimes. Hardship plus lack of freedom, explosive mix, led to overthrow of rulers, wider instability. And these crises create space for new political actors. In Spain, the Ho 15 Indignados helped fuel the rise of O Podemos, shaking up the old system. In the U.S., O Occupy Wall Street after 2008 with its slogan, "We are the 99%," really changed the conversation about inequality.
So these crises aren't just economic events, they're junctures that can unlock huge political change, especially when acute pain meets existing problems like corruption.
And finally, let's zoom out to the international angle. This stuff rarely stays contained within one country's borders, especially today. International institutions get involved, and crises can shift global economic thinking.
How do bodies like the IMF fit in?
International financial institutions, IFIs like the IMF and World Bank, often step in during crises, especially debt crises. They provide bailouts, financial aid, but that help is also almost invariably conditioned on the country adopting specific policies.
These are the infamous conditionalities.
They often include austerity measures, spending cuts, tax hikes, plus structural reforms like privatization, deregulation, making labor markets more flexible, often with strict budget targets. Examples: Latin American debt crisis saw IMF mandating free market reforms. Greece, during the Eurozone crisis, faced extensive EU-IMF and mandated austerity for its bailouts.
And that involvement is often deeply unpopular in the countries receiving aid.
Hugely controversial. The involvement, the conditions, they spark intense political anger. Accusations fly. External interference, violating sovereignty, making social hardship worse. In Latin America, IMF policies were often blamed for deepening poverty, seen as outsiders dictating pain. In Greece, foreign institutions were often targets of protests. Critics also say IFIs sometimes prop up unsustainable debt, shifting losses from private creditors onto taxpayers. It severely limits national policy options, leading to these imported policies that might not fit locally, fueling tension.
These crises also really show how interconnected everything is globally.
Deleveraging crises, especially those with global roots or strong contagion, hammer home how linked modern finance is. Shocks transmit fast across borders through banks, investment portfolios often separate from just trade links. When falling asset values in one place force deleveraging, it tightens constraints elsewhere, triggering synchronized sell-offs. The GFC in 2008, starting in U.S. subprime, and the Eurozone sovereign debt crisis are perfect examples of this international contagion. Problems spread like wildfire, forcing international responses.
And these major events often force a big rethink of economic ideas, right?
They trigger intense debates, reevaluations of dominant ideologies. Is fiscal stimulus better than austerity? What are the limits of monetary policy? Do we need more financial regulation? How should the global financial system be structured? All get questioned. Japan's lost decade sparked huge arguments about stagnation, about whether stimulus worked.
And this can lead to real shifts in how policy is made globally.
Historically, yes. Major crises often lead to significant shifts in policy paradigms. The Latin American debt crisis helped push countries towards rudder neoliberal reforms. The high 1876 IMF crisis in the UK is seen as a watershed, marking a shift from Keynesian ideas towards monetarism, paving the way for Thatcherism. The 1997 Asian crisis led to calls for reforms in global finance. Deleveraging events expose weaknesses and, often slowly and painfully, drive overhauls of national policies and global rules.
And there's often a lot of finger pointing, a blame game.
Whose fault is it? Foreign speculators, international institutions, irresponsible domestic politicians, flaws in the global system. This blame game itself becomes a powerful political force. It shapes national narratives, international relations, and the direction of economic policy debate for years after the immediate crisis fades.
Wrapping up the political impacts. Deleveraging crises hammer political stability. Frequent government changes. Eurozone 1019, Argentina 5 presidents. Loss of public trust. Economic pain fuels movements challenging the system. A New Deal, Latin America's shift to neoliberalism, Arab Spring. Create space for new parties. El Podemos, Occupy Wall Street's We Are the 99%. Internationally, IFIs intervene with controversial austerity conditionalities. Crises reveal global contagion, OGFC, Eurozone. And trigger debates leading to shifts in upward policy paradigms like UK 1976 IMF crisis, often amidst a global blame game.
Spot on. And the flashcards for politics and international. Political instability, high debt plus deleveraging trouble, government changes, frequent, e.g., Eurozone, Argentina, policy paradigms, crises drive shifts, e.g., neoliberalism, monetarism, low austerity, common controversial response, fuels unrest, social unrest, triggered by hardship cuts, e.g., Greece, Spain, Argentina, IFI conditionalities, aid tied to often painful austerity forms, global contagion, shock spread via finance, GFC, Eurozone, new political actors, crises create openings, Podemos, Occupy, blame game, potent political force post-crisis.
We spent a lot of time on the pain, the social cost, the political chaos of deleveraging. It sounds incredibly difficult, frankly bleak. But you mentioned our sources point to a few notable instances where maybe the worst systemic collapse, mass hardship was partially avoided. Is there ever a way to escape the gravity of debt without just crashing and burning?
This is where we look for those rare exceptions, the cases where maybe a soft landing was achieved during deleveraging. Now, the source defines a soft landing as an economic slowdown that tames growth and inflation without causing a major recession or a terrifying surge in unemployment. These are rare, but understanding them might tell us if escaping that painful no-exit path is ever truly possible. We need to look at what made those cases different. What policies, what factors were at play? Why didn't they spiral down like so many others?
Let's look at the examples. First up, Britain after the Napoleonic Wars. That's a long time ago. Feels like a different world.
It was Britain post-Napoleonic War, 1815-1850, but it's a fascinating case of sovereign debt deleveraging. The context was extreme. Government debt hit over 200% of GDP in 1815, just massive after decades of war. Britain had to switch at peacetime and deal with this overhang. The first few years were tough as slum, partly due to deflation as they returned to the gold standard. They avoided a prolonged nationwide depression, even with social distress for returning soldiers and farmers.
How on earth did they get debt down from over 200% GDP?
Primarily through sustained fiscal discipline plus economic growth. The government basically stopped adding new debt, stabilized it in nominal terms. They ran primary budget surpluses year after year by keeping high wartime taxes and minimal non-military spending. With the debt level flat, the economy, powered by the accelerating industrial revolution, grew faster than the debt. GDP growth just steadily eroded the debt to GDP ratio. By mid-century, 1850, it was half to about 500%.
And they did this without defaulting or massive inflation.
No default, no high inflation. Prices were stable or even falling gently under the gold standard.
So the magic formula was fiscal discipline plus growth.
Yes, plus some other key things. Sustained surpluses maintained market confidence. Britain's global economic power and growing trade revenues were a huge tailwind. And there was a kind of early financial repression. The Bank of England's credibility kept interest rates low, making the debt manageable relative to growth. Peace also freed up resources for industry. Now, there were recessions, there was social pain, but no catastrophic crisis. Unemployment didn't explode everywhere. The overall growth path held. Debt kept falling, below 50% by 1890. It shows. So sustained fiscal discipline plus supportive monetary conditions, low real rates, plus an expanding economy can cut sovereign debt without collapse.
Next example. The U.S. after World War II, another massive war debt situation.
The United States after World War II, late 1940s, 1950s, another sovereign deleveraging case. Federal debt was huge, above 120% of GDP in 1946. The big challenge, switch from wartime economy, absorb returning GIs, handle inflation without sliding back into the Great Depression. That fear was very real.
And the U.S. debt ratio came down incredibly fast then.
Phenomenally fast. It plunged to about 60% by 1956, under 50% by 1960. Sovereign deleveraging via potent mix, extremely high growth, moderate inflation, and fiscal prudence. The U.S. economy just boomed, end of rationing, pent-up demand unleashed. Inflation was allowed to run moderately above interest rates sometimes, which effectively shrank the real value of the existing debt.
How were rates kept low?
The Fed, working with the Treasury, kept nominal rates low. Wartime caps persisted for a while. This created negative real interest rates during inflation spurts. And fiscal policy. Huge war deficits became relative restraint. Spending was slashed after 45. They ran nearly balanced budgets, were primary surpluses.
So growth, a bit of inflation eating the debt, and fiscal control.
Yes, plus deliberate financial repression, keeping rates below inflation, managed the interest burden. Two inflation spikes after price controls ended 46-47, and during the Korean War, 50-51 eroded real debt significantly. But these were contained. The Fed made sure they didn't spiral. Defense spending dropped sharply. By the late 50s, debt was clearly falling. Strong external demand helped too.
And the outcome was a soft landing.
A remarkable one. Debt plunged. They avoided severe recession, mild short ones in 49-53, nothing like the 30s.
Right.
Unemployment stayed mostly low, 3-6%. Amazing given the workforce changes. Low inflation, strong growth. Sustainable. Helped by unique post-war factors, yes, but it illustrates again. Sure, supportive monetary policy, low real rates, plus fiscal discipline can reduce sovereign debt while maintaining stability.
What about Ireland in the late 80s? That wasn't a post-war boom. Sounds like they're in real trouble.
They were. Ireland in the late 1980s is sovereign fiscal consolidation with growth, but starting from deep crisis. Mid-80s, recession, unemployment around 17%, public debt, so 116% GDP. Credit doubts, people emigrating. In 1987, a new government went for bold fiscal cuts amid widespread pessimism. Escape the debt trap, reignite growth, find a soft landing out of a hard downturn.
How did they manage that turnaround?
Sovereign deleveraging via aggressive fiscal cuts in the Program for National Recovery, PNR, 1987. Earlier tax hikes hadn't worked. This time, the focus was expenditure cuts, structural reforms. Spending slashed welfare, health, public jobs. A huge budget turnaround. Primary balance swung by 10% of GDP from deficit to surplus in a few years. Social partnership helped moderate wages.
Painful cuts at home. What else helped? External factors.
External factors, yes. The decisive cuts boosted credibility. Irish interest rates fell. Incomes policy helped competitiveness. Currency adjustments and falling inflation improved the real exchange rate, boosting exports. The timing was good. Strong growth in key trading partners, UK, Europe, US, created booming demand for Irish goods. Ireland's strategy to attract foreign direct investment also paid off big time. A fiscal austerity at home was basically offset by soaring external demand and investment inflows.
So they cut internally while the global economy gave them a lift.
Pretty much. The result became known as expansionary fiscal contraction. The economy took off after 1987. Real GDP growth jumped to discover 5%, stayed strong. Unemployment fell from 17% towards some 13% by 1990. No new recession, growth accelerated. Inflation fell below 3%. Public debt went from 116% down steadily, hitting 34% by 2000. The Celtic Tiger was born. Successful, sustainable, it shows. Decisive fiscal consolidation plus structural reforms plus supportive external climate can work. Fiscal pain met external growth.
Belgium in the 1990s, what was their story?
Belgium in the 1990s. Gradual debt reduction under EMU constraints. Early 90s, very high public debt, peaked over 130% GDP. Chronic deficits, slow growth, high unemployment. They were under pressure to qualify for the euro, which meant cutting debt and deficits. The challenge? Fix the finances without killing the recovery from the early 90s slump. A soft landing while deleveraging.
How did they achieve that slow, steady reduction?
Sovereign deleveraging via what they called a glorious consolidation decade, mid-90s to 2000s, persistent fiscal discipline. Ran very large primary surpluses, averaging 5.5% GDP for a decade. Steadily paid down debt principal. How? Almost all through spending restraint, curbed welfare growth, froze public wages, reformed pensions. Public spending fell as a share of GDP. They also got a huge boost from lower interest costs as markets gained confidence and euro conversions kicked in. Wiped about 40 percentage points off the debt to GDP ratio over the decade.
So strict spending cuts plus falling borrowing costs were key.
Yes, and political commitment was sustained across governments. The prospect of EMU membership acted as an external anchor forcing discipline. Monetary policy helped. Pegging to the German mark imported low inflation, then euro convergence drove borrowing costs down towards German levels. A virtuous cycle. Plus a favorable external environment, late 90s helped exports. Moderate wage deals kept them competitive. It was a mix. Strict fiscal austerity, spending cuts, plus structural reforms, plus low interest rates. The reward for credibility.
And the result?
Impressive debt reduction. from 134% down to nearly 84% by 2007, avoided severe recession, just a mild dip in 93, moderate growth of 2-3% FG late 90s, unemployment edged down to 7%, consolidation happened with low inflation, stable growth, textbook soft landing, met Maastricht rules, joined the euro, sustainable until the 2008 GFC hit. Highlights. Long-run debt can be reduced without mass unemployment via credible fiscal tightening plus cooperative monetary conditions plus solid external growth. A soft landing by stretching it out, slow and steady.
Canada in the mid-90s is interesting because it involved both government and households deleveraging together.
Yes, Canada in the mid-1990s. Household and sovereign deleveraging without recession. Early 90s, Canada had debt problems everywhere. Federal gov, 70% GDP, 100% including provinces. Households heavily leveraged after an 80s boom. By 94-95, investors were sounding alarms. WSJ compared Canada to a third world country. Households were also still recovering from early 90s recession. Unemployment hit 11%. Weak Canadian dollar, fragile confidence. Goal, fix the debt mess without another crash.
How did they manage that double act?
Sovereign fiscal consolidation plus private sector repair. The 1995 budget brought sweeping spending cuts, federal programs, provincial transfers, public jobs, cut program spending nearly 10% over 2 years, turned a large deficit into surplus by 1997. Federal debt to GDP fell sharply from its peak down to about 31% by 2001. And households. They also pulled back on borrowing after the recession. Credit growth slowed, savings increased, both sides deleveraging.
What made that soft landing possible? It sounds tricky.
Supportive monetary policy was key once inflation was under control. The Bank of Canada cut rates. Falling rates softened the blow, helped business investment externally. The booming U.S. economy in the mid-late 90s was a massive help for Canadian exports. And an early weak Canadian dollar, record lows versus USD in 95, also made exports super competitive. Fiscal reforms were seen as credible, structural, that boosted confidence. Households benefited from strong job and income growth later in the 90s, allowing them to fix balance sheets without slashing consumption dramatically. A credible fiscal tightening actually improved confidence.
And the outcome, a model soft landing.
Often held up as one, yes. No new recession during the austerity. The economy actually accelerated after a brief slowdown in 95, averaged 3.5% GDP growth, 96-2000. Unemployment fell from 11% to below 7% by 2000. Inflation stayed low. Federal debt ratio basically halved in 5-6 years. Households stabilized their debt. Sustainable. Key supports. Co-supportive monetary policy, competitive currency, strong trading partner growth, falling debt, falling rates, rising growth, rising employment, a rare and successful combination. Though household debt did rise again later.
Finally, the U.S. after the 2008 crisis, more recent history. United States after the 2008 crisis, 2010s. This is household deleveraging with sustained recovery. Context. Massive household debt boom peaked at 98% GDP early 2008. Housing crash, Great Recession, severe downturn, unemployment hit 10% in 2009. Then came aggressive policies to stabilize things. From 2009 onwards, households went through years of painful deleveraging, paying down debt or defaulting. Aim, foster recovery without another crash, a soft landing as the private sector healed.
How did households actually reduce that debt burden?
Between 2008 and about 2013, they significantly reduced debt relative to income. Some involuntary defaults, foreclosures, some voluntary saving more, paying down loans. Total household debt fell from 98% GDP to around 80% by the mid-2010s. Mortgage debt dropped. Credit card balances fell over 20% nominally. The saving rate jumped from 3% to 6-8%. This deleveraging was a drag on growth, kept consumption subdued. The challenge was keeping the recovery going despite that.
What policies helped the economy recover while households were cutting back?
A powerful combination of aggressive monetary and fiscal policy. The Fed cut rates to zero and kept them there for 7 years. Launched massive QE, buying bonds to lower long-term rates, ease credit. Low rates made it easier for households to refinance, service debt, freed up cash flow. Fed policy also helped support asset prices, stocks, housing, which rebounded after 2009, repairing balance sheets.
And on the fiscal side?
Huge government spending. Massive stimulus in 2009-10, ARA, then sustained large federal deficits of 5-10% of GDP for several years. These deficits essentially propped up incomes and demand while households were deleveraging. Government borrowing filled the gap left by private sector cutting back. Loan mods, extended unemployment benefits, also helped cushion households. Analysis suggests substantial government deficits enabled households to deleverage while along recovery.
So did it work? A soft landing?
Navigated post-2008 without a dreaded double-dip recession. So yes, a softish landing. The economic expansion lasted from mid-2009 to early 2020, the longest on record. Growth was moderate but steady. Unemployment fell persistently from 10% down eventually to a two-year low of 3.5% by 2019. All while households reduced their debt burden. Low inflation too. Households got healthier financially while the economy grew. Sustainable policy was key. But there's a big caveat. So now the debt burden largely shifted from households to the public sector. Government debt soared. So a soft landing from the perspective of household stability and avoiding another crash, but the overall debt didn't vanish, it just moved.
These examples are fascinating. They show that sometimes, under specific, often lucky conditions, economies can deleverage without total catastrophe. Things like sustained fiscal discipline, supportive monetary policy reforms, good external conditions, they all seem key. But even the soft landings often involve pain, difficult adjustments, or just shifting the debt somewhere else.
That's the key takeaway, comparing these soft landings to the really painful ones. The successful ones seem to need that combo. Credible domestic policy, even if painful, supportive money, low real rates, and a helping hand from outside, strong trading partners, competitive currency, often stretched over a long time. The painful ones, more abrupt shocks, less policy credibility, maybe external headwinds, and even the soft U.S. post-2008 case involved a huge initial shock and just moved the debt problem.
So final question on this. If you were a policymaker today facing high global debt, synchronized tightening, what would you prioritize trying to achieve a soft landing? Is the current global environment even conducive to one? Something for you, the listener, to think about.
Wrapping up this look at soft landings, we saw rare cases like post-Napoleonic Britain, post-WWIR US, Ireland late 80s, Belgium 90s, Canada mid-90s, US post-2008, where huge debts were cut without depression or mass unemployment, facilitated by credible fiscal policy, supportive money, external help, reforms, time. But remember, these were exceptions, often unique circumstances, and pain or debt shifts still happened. It highlights how incredibly hard, maybe not impossible, but very hard, it is to escape debt gravity without serious hardship.
And the flashcard facts for soft landing definition. Slow down without major recession, unemployment spike. Britain, 1815-50. Sovereign debt halved, industrial rev helped. So U.S. post-WWIR. Debt whore, 120% to 50%. High growth plus so financial repression. So Ireland, late 80s. Expansionary fiscal contraction. Debt, 116% to 44%. Export boom helped. Belgium, 1990s. Debt, over 134% to 84%. Long consolidation plus, EMU anchor. Canada, mid-90s. Public household deleveraging. Federal debt halved. U.S. boom helped. U.S. post-2008. Household deleveraging, 198% to 80%. Debt shifted to public sector. OT soft landing factors. Credible fiscal, supportive monetary, favorable external reforms, time. With soft landing caveat. Still involved pain shifts, not painless. With soft landing caveat. Hashtag take outro. Well, this has really shown that large-scale economic deleveraging isn't just some dry financial exercise, it's a profound shock to society. It has these severe social, political, international consequences that echo through history and touch millions of lives.
That's right. We've seen those powerful, often vicious feedback loops. Economic pain fuels social hardship, which ignites political crises, and then political responses like austerity can tragically make both the downturn and the suffering even worse.
And the common consequences are just stark repeating across countries, across time. Severe, long-lasting unemployment leaving scars, poverty surging, inequality deepening, straining the social fabric, huge pressure on welfare systems, often leading to cuts when they're needed most, widespread social protests and unrest against austerity, and significant political instability, challenging governments, sometimes driving fundamental shifts in how countries are run. This whole process is, as the sources say, inherently painful, frustrating.
And the legacy can last for generations. Lost generations facing fewer opportunities, fundamental changes to norms around work and security, lasting ideological shifts shaped by how the crisis was handled, who was blamed, what lessons were learned or ignored.
We did contrast this with those rare historical soft landings. While it seems possible sometimes to deleverage without a full-blown depression or catastrophic unemployment, those cases were few. They relied on a difficult, specific mix of factors: credible policy, supportive money, good external conditions, reforms, time, and even then, pain and burden shifting often happened. It just reinforces how incredibly challenging it is to find a truly painless way out of high debt.
Which underscores the huge challenge for policymakers today. How do you manage this deleveraging in an orderly way? Minimize the immense real economy costs, protect vulnerable people. That fundamental debate between stimulus and austerity continues, and history offers complex, maybe contradictory lessons depending on the context.
Ultimately, understanding the political economy of it all, who wins, who loses, how those impacts shape political reactions and social outcomes seems vital for navigating these recurring, often devastating crises.
So thinking about the current situation, we started with high global debt, synchronized tightening. What does history really tell us about maybe the inevitability of pain when unwinding leverage? And what might that imply for political and social stability in the years ahead? What role might understanding this history play for you as a citizen trying to make sense of these turbulent times?
Deleveraging is not just a financial event. It's a political reckoning, a social fracture, a generational turning point. It rewrites labor markets, upends governments, strains families, and tests institutions. But it also clarifies what matters, what's resilient, and what was only ever sustained by borrowed time. As the world enters a new era of tightening and retrenchment, the question isn't whether the system can shrink. It's whether it can survive the shrinking. Thanks for joining.
Please like and subscribe.